Okay, so I know there's a few more people that are supposed to be coming on, so hopefully they join at some point and can get in. But we will have this up hopefully by the end of the day today or tomorrow with a link that you can view this webinar going forward, and I believe we'll post it to our website as well. So this is our first webinar for the year. So we're going to start with where are we now? So sort of a market update from 2022 and some insight into where we think 2023 is going to go. And so let's get started. So here's a little agenda for what we're going to do. We're going to talk about the prices of 2022, what's happened with the mortgage rates increasing and how that affects your buying power. We're going to look at one slide, which is very interesting, about how the mortgage rates have affected since January 2022 to January 2023, the difference in market prices and how much mortgage rates have affected and the difference in either buying power or possible savings. Yes, savings, even in a down market, it might be better to buy now. We will talk about that. And then we will go into our predictions and a little bit of a market forecast for this year coming up. In the last 2 weeks, we've seen quite a bit of change, so we'll have some insight into that. And then we'll talk about, yes, should you be buying or selling now, or upgrading or downgrading? That's what we will end with, and then a little question and answer period for anybody who has any questions. Okay, so let's dive right into the prices. So since 2020, you can see we have gone a lot higher than where we were. So 2020, this is just all homes in Durham region, average price starting at 577, 791. That was for the entire year average for 2020. And that was the start of COVID. So what we all thought, we thought we were going to see a halt in the increasing of prices due to COVID. The exact opposite happened. Prices went through the roof. Everybody was buying, trying to get into the market if you weren't, and prices skyrocketed. So that year alone, from 2020 to 2021, it was about a 35 to 40% increase just that year. So that left us at 2021 at 796. And then as prices sort of stabilized for that year, there was a brief period of stabilization, but it was still going up. And again, we saw a large increase in 2021 all the way through to 2022 until January, February, where we sort of hit our peak in February of last year. So you will see in our next slide, so even though this shows it constantly going up, you'll see as we have prices of 2022 in the specific area of detached homes in Oshawa. So last year we started with an average price of $1,020,000. So detached homes in Oshawa, January, $1,020,000. We peaked in February with almost 1.1 million. Then we started to see the mortgage rates increasing, and it immediately took a sharp nosedive. So, people got scared. All of a sudden, interest rates were going up. People were not getting into, they were still selling, and they were still selling over asking, but the prices started to sharply come down. So we hit July, and that was basically the bottom that we've seen so far based on our market stats. So July, we hit 765 as an average selling price. And then we've sort of stabilized, a couple percent increases here or there. We rose a little bit in September, and then we saw the mortgage rates go up again. And so that also affected price. So it started to come back down again. But it had basically stayed around that level since July until December. We don't have market stats yet for January of this year. But we will talk about that a little bit later, of what we think is going to happen. And we're starting to see, I believe it will be a little bit higher than that 774 mark. I think we might be closer to the 800, somewhere around August, September levels. Okay, so we've seen a sharp decline in price, about 25% 25 to 30%, depending on neighborhood, depending on area, types of houses. But this is a pretty good average. This is just the detached homes in Oshawa. So if you're in Pickering or Ajax, would be in Durham region in general, even GTA in general, about a 25 to 30% decrease since the peak. Again, depending on neighborhoods and depending on how far out of the GTA you are, you're going to see some slight variation in numbers, but this is a very good average to give you an idea. So the reason why this has happened, and we'll go into the next slide here, is the mortgage rates. So we know as of January 26th, we had a 0.25, that was the basis points for Bank of Canada, right? So we started to see increases starting in March of last year, and it started slowly, but it had a very sharp effect on the market. So February was the peak. March, April, May, June, and July is when we took our huge decreases. Now you can see that the interest rates weren't increasing that great at that time, but it had a sharp effect on the market. So March we went up 0.25, April we went up 0.5, June again 0.5, July was the biggest increase with the 1%, and we saw the prices started actually to increase a little bit after everybody was seeing the average price in July being so low at $765. And then we saw by September, again, the prices were up a little. They increased the rate again, 0.75, October again, 0.5, December, 0.5. And we just had our last increase of 0.25 last week on Wednesday. And they have now said this is the stopping point. So we are now at 4.5%. So a huge increase. It's actually the largest increase in such a short period of time ever to date, ever recorded, to go basically 4%, 4.25% within a year. That is unheard of almost. But we can see that the market prices have leveled out despite the last 2 to 3 increases in the mortgage rate. So prices have stabilized even though the rates have continued to go up, and now we have halted the mortgage rate. And the real ideal of raising the mortgage rates is for inflation. So the target is a 2% inflation rate, and we were, I think, hovering around 8 or 9% previously, and so it is coming down now. The idea is to not allow us to go into a recession, and we're sort of in a mini recession, maybe. That's what the idea, what some analysts have been saying, and hopefully we've sort of hit that, and we're going to start to see GDP come back and inflation come down to that 2% level, and then we might see an easing off some of these mortgage rates. So we might see even a drop by 2.5 or by 0.25 or maybe by 0.5. The US has already started to lower their rates. So a lot of analysts would like to say, we follow the US a little bit. We're usually 3, 4, 5 months behind them. So if that's the case, we might start to see rate decreases in the summertime, maybe the fall, but likely they're not going to be very sharp. The US also has an interest rate that's much higher than ours. I think they were around 7%. And so we're at 4.5, they're at 7, they can go down to 6. I don't see us going back down to 3%, but that might be in like a 2-year time frame. But minor decreases might happen later in the year, or we're hoping. But we should see a leveling of the rates for a little while. We shouldn't see any more increases. Okay, so what does this mortgage rates now have to affect on our home prices? And let's go to our next slide here. So a 1-year difference in the mortgage. This is really important to think about. So last year, January, almost near the peak, when the average sale price was around 1.1 million. Now this is sort of GTA specific, but it's still a very good average for our market. So 1.175 was the average price. The average fixed rate was around 3%, 2.99%. Somebody who puts down 20% down That's avoiding the CMHC penalty tack on to your mortgage. You're putting 20% down is $235,000. So then your balance of carrying a mortgage is $940,000. So that's important to note. That's your mortgage balance last year, $940,000. Your monthly payment at that rate, 2.99, $3,948. The balance on your mortgage after that 5-year term, $835,293. So now if you look at the exact same house based on market conditions changing, oh, sorry, there we go. The average sale price of that house would be right around $892,000. Now the rate now, 5.29 is a good rate. Even that's probably a great rate right now if you could get it. It might be slightly higher, but anything around that rate is very good. If you put down 20%, you're looking at $178,000 rather than $235,000 as your 20% down. Your mortgage is $714,000 instead of $940,000. Your monthly payment actually is very similar. It's actually a little bit less at $39.35. And your balance in 5 years is $657,921, which is a difference of, I believe it's $177,000. We click $177,332. So if you were buying in January of 2022, you were going to be buying most likely for over $1 million. Now that same house is worth $900,000. Yes, your rate is up, your qualifying rate and your mortgage rate is going to be up. But if you look at your down payment, you don't need to put as much money down. Your mortgage amount is going to be much less, and your monthly payment is roughly around the same. Your balance in 5 years, this is the thing to really keep in mind. Real estate, we like to think of it as a long-term investment, right? So if you're buying a house to flip it, you know, this might not apply to you, but for most people, you're going to buy a house, you're going to live in it for 5 years, 10 years. Your balance after 5 years being $657,000 is a lot better than $835,000. You're saving $177,000 buying that house right now, as opposed to last year, which is a huge amount of savings. So it's not necessarily such a bad thing that the mortgage rate has gone up and the prices have come down, especially if you are a first-time buyer. You're saving a lot of money if you can get into the market now. And if you are thinking about selling or upgrading, it is a perfect time, because now you're saving all of this money instead of, you know, having to spend and maybe get into the multiple offer scenario of 20, 30, 40 offers and spend an extra $200,000 on a house just to get it, increasing your total mortgage. Now we're seeing some houses sitting on the market. You're able to negotiate. You're going to have a less of a total mortgage. Your monthly payment might be right around the same amount. It could be a little bit higher, a little bit less, but your balance for the long term is going to be much less now than it would have been a year ago. So when you think about that over a long term, a 20, a 25-year mortgage, how much less are you going to be paying over the time? And if you can pay it down even faster, you're going to save hundreds of thousands of dollars by buying now rather than last year. So it's not all doom and gloom just because the mortgage rates have gone up. So our next slide here is sort of what we sort of think is going to happen, and based on what we're seeing now. So like I said before, the interest rate hike is over, or it is halted, at least for now. They've left stipulations, so unless we see something terrible, we might have to raise the rate again a little bit. But we should see a stabilization for the year and hopefully a possible decline in the mortgage rate later, midsummer or fall, hopefully. We were seeing sluggish prices in January. It is picking up now. In the last 2 weeks, it has definitely picked up. Multiple offers are back. And mostly this is because we are at our lowest amount of supply in terms of listings in the last 20 years. So we are having, I think it's about a 40%, 30 or 40% year over year shortage in listings. So we have now buyers who are seeing the bottom of the market, that the bottom was in July, but we're very close to that number. The mortgage rates have stopped going up, according to the Bank of Canada, and we have a very shortage, or a high shortage in listings. So we still have all these buyers now that are waiting and maybe trying to possibly time the bottom of the market. While we're seeing the bottom is gone and we're in a level market. But now these buyers are coming out now that they know this is the new rate. We're going to have to deal with this. We're going to have to buy now before prices start to go back up. And if we know supply and demand, when we have a low supply and demand is high, that is just going to drive price up. So if we start to see a lot more listings, maybe that can level out prices and doesn't bring multiple offers back, but we're seeing a huge shortage. So it's still very much a seller's market. It was balanced. We thought it was a balanced market in, November, December, we were seeing, but it was still edging towards a seller's market. And I still think we are in a seller's market now. Prices, according to Benjamin Tal, who just had a webinar himself about predictions for 2023. We should see some moderate increases in prices. And in the last 2 weeks, I'm going to say we have seen some increases in the prices. So listing prices and sale prices, we're seeing the over asking back. Some people are still trying to list low. We're seeing that as a strategy, but in terms of market value, prices I still believe are up. So we're going to see that average price in January. I believe in December, I think we were at 775. I think we're going to be closer to the 800 mark again in terms of our average price. So I don't know what percentage increase on that. It might be a 2, 3, 4% increase, something close to that, month over month from December to January. But I believe we're going to start to see it go up. And once those stats come out, it's sort of, well, what is that going to do to the demand? Are the buyers going to start coming out in February again and seeing that, oh, prices are coming out, multiple offers are back, mortgage rates have leveled off. We might start to see a busier February, March than we thought we were going to have, but we don't know. We will see. And then the other big factor is the war in Ukraine is still happening, and what is Putin going to do? And we don't know. That's the big thing. Nobody knows. We have some ideas that something in the spring might happen. We know energy prices are tightly related to what's happening in Russia, and we have seen increases in everything at the pumps, the food. Energy is going up as well, and the food is obviously related to the energy market as well. The more it costs to run any sort of food producing farm or these factories that are shipping. So anything like that, it will be affected by the war in Ukraine and what happens. That is sort of the anomaly that nobody knows about, but we will keep tabs on it to try and see. There's not really a prediction on that, but we could see a big change in the market just based on what happens. But if sort of that, stays the way it is now, we expect sort of small increases of the year and hopefully a decline in mortgage rates going forward, maybe in later in the year. So based on that, we can go to the next slide. Should you be buying or selling now? So our market now is a very good time to be buying. We know that the market has bottomed out in July. We're starting to see a level off in the prices. We know the mortgage rates are stable. And so if you can qualify now, you're basically buying at the best price that we can see. Could it go down? Yes. But we thought it was going to keep going down as mortgage rates went up, and it didn't. And that happened for about 3 or 4 months. So buying, if you wanted to time the market, you would say July would have been the best time to buy. But nobody knew that at that time. So if we're going to say, should you be buying or selling now? The ideal person to be buying or selling now is a first-time buyer who can get qualified. you're going to be buying at a better price this year than you would have last year. And we can go back and look at our mortgage slide from January to 2022 to 2023. If you are upgrading, think about selling. If you're in a first-time buyer home, or maybe it's your second or third home, but you're looking to maybe get into your dream home. Now is a great time, if you have any sort of equity built up in your house, that you can now sell and buy, negotiate. Hopefully, we're seeing multiple offers come back, but hopefully you can negotiate. But your buying power is a lot better now than it was a year ago. So you're in a much better position to be upgrading right now than you were a year ago. So anybody who's considering upgrading, now is a much better time than it was a year ago. You're going to spend less, your mortgage will be less, and you should really consider now, not waiting. The only person who maybe shouldn't be selling now, and we'll see as of right now, if prices start to go back up, would be somebody who is just selling a property, not buying another one. Because if you were just selling, yes, you could have said, well, if I sold last year, I could have got $1 million, and this year now I'm going to get 750 or 800. Yes, maybe you would have been better off selling last year than this year. It's a very small number of people who are just selling a property and not also sell and buy. So those would be the only people that I would think you might want to wait till spring or summer to see what happens over the next few months. If prices start to go up again, then, as prices go up, obviously you're going to net more money if you're just selling. So that would be my take on buying or selling right now. So I'm going to open it up if Varun has anything to add. I'm always on mute, but.
No, nothing to add. I think it was great. We'll let our lovely attendee ask any questions, but I got some for you as well. But maybe you can ask some questions first. Answer those.
So if anyone has any questions, yes, ask away. Janet, are you there? Any questions?
Yes, I'm here.
You're here.
No question.
No questions. Perfect. I answered everything.
I'll ask one. What do you think? I know Government of Canada has committed to bringing in a lot more immigrants post-pandemic. What do you think that's the impact that's going to have on these prices and on the market in general?
Right. So that was we should have touched on that. Good thing you asked that question. So we know that the average has been around like 400 to 500,000 immigrants a year. Actually, Benjamin Tal said last year we had 950,000 immigrants come to Canada between the war in Ukraine, foreign students, and just natural immigration. We know most of them settle either in BC or Ontario, and then some in Quebec, but the majority is BC and Ontario. So we're seeing a huge number of increase in immigration towards Ontario, which obviously, and most of that becomes GTA as well. So it's a supply and demand issue. We know we are already in a shortage of supply, which is partially why the GTA prices have been driven up so much, is we're in a massive shortage and we're not building enough to meet the demand. So that gap is only increasing, it looks like, for the next 2 to 3 years. If not longer. So unless the government steps in and starts building a lot more, or builders are able to build a lot more, but we know that the prices of everything have gone up, and it's harder for builders to economically build as well. So rising prices in material and labor costs, all affecting this shortage that we have. So based on that, based on the mortgage rates sort of stalling out right now, the likely scenario is that this sort of down market is very short. So we're expecting moderate increases this year, and I think it's because media pressure and buyer and seller sentiment right now is there. Everybody's fearful, to either think, oh, I'm going to buy now or I'm going to sell now. We don't know if it's going to go down or up. In the short term, I think we're going to see a little bit of increases, and that'll start to bring buyers back to the table, sellers back to the table. And then I don't know if we'll see a market increasing the way we did. We shouldn't certainly see a COVID market where we increase 30 or 40% a year, but I would not be surprised if we start to see back to the 5 to 10% increases, maybe 15% a year, if the supply and demand levels stay as they are and continue to be in a shortage. So short-term moderate increases, long-term probably big increases. That's my bet.
When it comes to mortgage rates, I know you mentioned that this has been the highest or the biggest increase that they've done in such a short amount of time, and you anticipate them going down. Do you anticipate them to go down to sort of pandemic levels where it was practically like free money, or what are you seeing? What do you think is going to happen?
So most analysts would say that the pandemic level of mortgage rates were absurd. That to be that low is almost unhealthy, and it sort of created the problem that we have of an increase of that much. When you're lending money out for basically free, then this is what happens. So the rates, I think, and most analysts would probably say, if we can get back down to a 3 to 3.5% rate, so which would end up being your fixed rates now are roughly around 5.5 to 6%. If we get those fixed rates down to anywhere between a 3.5 to 4.5, maybe even 5% rate, that's probably the healthy level that we should stay at. And it's also based on our prices, right? You got to think, we had a 4.5% rate when prices of the average price of home was 400,000 or 500,000. Now that average mortgage rate has gone up. We're at 5.5, 6%, and the average price is around 900,000 now. So it's almost double what it was. So of course your mortgage payment is about double. It's what also can people afford. So it's a lot harder to afford a home now than it was 5-10 years ago. So if we bring the mortgage rates down a bit, if inflation gets under control and we lower those rates to around a 3.5, 4.5%, that eases the stress level on buyers and just monthly mortgage payments. So I think that is the goal. I think the goal is to be around a 3.5, 4.5%. But again, time will tell. We'll see if we start to glide down like the US has. And as we tend to follow their market a little bit behind, 3 to 6 months behind in general, they've started to go down already, but again, they were much higher than this. So. Anything else? Does anybody have any other questions? No? Okay, so I want to thank everybody for attending. And again, we will probably post this link up today, tomorrow, hopefully, so that you can go back and have a watch. Or if you weren't able to attend live and you registered, I know we had a few people who registered, but they weren't on. You will have access to the link, and we will make sure that everybody can get it on review. We will be doing another webinar probably later in, we're in February tomorrow, probably in later February. And I believe our topic for that one will be a first-time seller. So anyone who's thinking about selling, maybe it's your first home, what would be the steps and proper preparation in order to sell your home in this market now? And maybe we'll touch on if it's a crazy market, and we'll see in a month. It might be a completely different market than it is now. But so in a down market, in an up market, or in the market we're in now, what should you do as a first-time seller in order to get the most money for your home? How to market it properly, and all of those sorts of things. And then I believe in the following months we'll cover more in depth on mortgages, maybe on renovations to do in your home. So we're going to have a variety of topics coming up in our future webinars for everybody to see, and we'll always make them available even if you can't make it on live. Okay, so I want to thank everybody for attending or watching our webinar after the fact. And if you have any questions, you can always reach us. I I'm Justin McFadden. I know Haroon is on the call. We're the Haroon Iqbal team. You can reach us. I am Justin at soldbyharoon.com. I know Haroon is Haroon at soldbyharoon.com. Or you can see us soldbyharoon.com, our website, and send us an email or text us. Our phone numbers are always there. So reach out if you have any questions. Okay.
Thank you.
Bye.